I think the PMI, the numbers show us what we already know. We know that there's a holdup in manufacturing because of this trade war. I also would posit to say that the trade war is not going to go away because this is an ideological Cold War that we're going through, and trade is just on the surface of it. But that being said, you got to look at the manufacturing across the globe. It's all slow. The prices are cheap, and we're talking about something that's already happened. So I think now is a time where you get more interested in those cycles, get more interested in industrials. I mean, you've got, you just look at things like industrials and financials. That's the bulk of your small cap value stuff that's killing everybody right now. And that's where there's pessimism. There's not, a few months ago, Germany, there was not a ray of light of any hope in their manufacturing numbers. This is where you buy it, right? And so if you're looking to buy something over the next couple years, and you want to thumb your nose at recessionary fears, I would say go with what's beat up, go where it's completely left for dead. Is anybody excited about manufacturing or European equities right now?
Well, so I think we had a lot of people making fun of BlackRock today because just today, and it takes a long time at firms like BlackRock to get anything cleared through compliance. This had been in the works for a while, but they chose today to publish a piece about why there was a global growth recovery looming ahead, that the next few months would actually see the economy do better. I kind of felt like that's what the market had been telling you. And so I kind of hear you saying, look past today, because the market over the last several weeks has been clear. The economy is going to get better, and all the stuff that we got worried about in August, we decided wasn't an issue. That's what this chart is telling you.
Well, and also look at this big sentiment shift from growth to value. Right? Last month, we had the biggest surge in value or value strategies, which are just cheap, dumpy, trashy stocks that I tend to love, right? And that's not just a one-off thing. That's a trend. And the thing about, never listen to these quants that always tell you things like, oh, you can't time this, you don't know, They always want to know the direction of something. I don't really care about the direction, right? What I care about is generally when, look at January 2000, look at 2007 as sort of examples. Right when the economy gets this last little gas, this last year, we're right now, we had an inverted yield curve. We got 18 months left.
Yeah.
But when you look at that, the cheap, trashy stuff, small cap value, that will surge right at the end into that consumer spending cycle, and then you have the big blow up, and then the value strategies, that's what surged going out. And so I think we're just seeing, when people say, oh, value, when I'm talking about this, it's like that happens right near the end. And when I say the end, I don't mean that pejorative. I'm saying, I think we got probably 6 to 9 more months of buy every dip.
So when you say that the opportunities are in those that are beat up right now, then maybe look outside the U.S., right? Like you mentioned, in Europe, that's kind of where you might see some attractive valued stocks. But what about emerging markets? Anything attractive there, given all the global concerns that we've seen that aren't tied necessarily just to Germany, just to Japan with negative rates?
Right. Well, so here's the deal. I did mention that the trade war is real and this isn't going to get fixed, right? And anything that we get on a trade deal will just be sort of a PR veneer, to make the White House look better. But we now have a decoupling of where the spheres of influence are. So emerging markets, when you say that to me, what I'm telling my clients is just think about that as Asia and the Chinese influence of that region. And I think you can buy them here. I was buying them last year, right, when they were down almost 30%. They're still down. The valuations are very low. I think it's a great hedge against this dollar right now that is just continuing to boost up. I think that's the last gap. I think the next move is down. So I'm not as excited about emerging markets. I hold them. Of my equity portfolio, I got 20% across the board in emerging markets. So clearly I'm a bull. I would just say, waiting to see if we get a little volatility in emerging markets, because with this rising dollar, the first thing traders are going to do is they're going to talk about the debt in emerging markets, how it's blah, blah, blah. I've been hearing that since 1983 about the dollar-denominated debt, but it'll bring those prices down 5 to 10%, and then you go and jam it in.
So, but it does kind of sound like you're saying we are on borrowed time for this cycle.
Yeah, what's wrong with that? Aren't we all on borrowed time?
As soon as you're born, it's just a march towards death.
Right.
Borrowing from whom?
That's right. So here's how I think you have to play it, though. Right now, you need to take this opportunity to ride this momentum for the next 6 months, at least, right? Because just because I say there's an inverted yield curve and that always seems to, cause a recession, except in 1968, is a pretty good signal, right? But you don't want to leave early, and also you can just scale out of U.S. stocks, next year, and start scaling into European equities. You just buy Europe, right? Bull markets are born in pessimism, no ray of light. 1.1 to 1.3 book on German equities. Italian banks have less and less percentage of non-performing loans to their loan book. I mean, the fact that anybody could say something nice about Italian banks these days. I mean, look at Santander. I mean, that thing was on fire last month on nothing other than the story is not looking worse. So, you know, Peter Lynch would say in growth markets back in the day, is the story getting better? The way I play emerging markets and European equities, which is going to be key to making money next year, because it ain't going to be in the US by the end of next year, is the story getting worse? And when the answer is no, you buy it. I think that's now.
But you have to have the stomach for that, because it could get worse before it gets better, right?
The music is still playing, basically, right? It's a dance.
Doesn't bother me. None of my clients are bothered. We have nice balance.
That's why you got snakes on your shoes.
Yeah, that's why I got snakes on my shoes. But it does take a reservoir of patience, and I will say, right now is where people get real jittery. They get into performance chasing. They look at the S&P. They have a referendum on the last 10 years. And you know what's typical? They just want, a lot of retail investors want what worked over the last 10 years. And basically, it's almost as if you have to flip those positions and say what's been worse the last 10 years to a point. I'm just saying, you know,
that brings me to financials, because I want to be convinced that financials are a buy right now. I mean, look at where rates are. Look at how every big bank is getting disrupted, whether it's, you know, Goldman having to go and do an Apple Card, become a consumer company, or Wells Fargo can barely find a chief executive. Like, what financial company do you think is a buy here?
Well, let me put it this way. When you look at the general group, what's holding back the performance here has a lot to do with regulatory concerns, the stuff you're talking about, the amount of money that has to be invested to fight off fintech and all these disruptors. But also keep in mind a couple of things. If we get rates to go a little bit lower, that yield curve is going to be in the bank's favor, number one. Number two, the refi boom is very real, and that puts more money in consumers' pockets, and that puts more marginal dollars into those bank deposits, okay? Then what you also have is, you just have these fintechs don't make any money. I mean, Robinhood, I love the idea of Robinhood, but how are you supposed to how is real money supposed to place money in a brokerage firm that can't make any cash, right? And when you look at the news from Charles Schwab today, I mean, that was shocking that they feel that they could screw the pooch on just, you know, it's one thing to say we're not going to make money on index funds and have that be a loss leader like Fidelity, but to say we're just going to have no fees at all on the brokerage side, and we're going to surreptitiously fleece and steal money from you because 60% of our money comes from cash sweeps, right? Then you start to see there's a war here. What's going to happen is it's going to peter out over the next year where these companies that can't make any money, we're either going to see increased M&A. I think that's like the thing. I mean, M&A is going to explode and everybody's going to be shocked by it. And these little fintech disruptors, they're going to run out of money or they're going to get swallowed up. And a couple years from now, oh yeah, remember all those little things? Like where did they get sold off to? So I would say I share your concern. I think it's the biggest problem with my bull case for small cap value are the financials. But again, it's predicated on consumers spending less, having less money in their pocket, housing becoming weaker where there's less refi and loan activity, and credit is not tight right now. I mean, just look at credit spreads. But I think it'll be a problem eventually, right? Just give us a year and a half.